In 2008, everything came crashing to an absolute halt. I remember sitting at my desk and thinking, oh my God, the world is going to come to an end. In this video, I'm going to tell you about the bubble popping and whether or not it looks like it. There's also two fundamental things to watch for from economists that show you whether or not housing is going to crash. We may or may not be seeing that right now. I remember sitting at my desk and thinking, oh my God, the world is going to come to an end. The world up to that point for me was real estate loans. I mostly did loans. I was a loan officer, and in order to be a loan officer, you need to have a real estate license at the time. And so I had a real estate license. Every once in a while, I would sell a home or I'd buy my own home. And my primary source of business was doing loans. And the reason for that was up to that point, the financing was very loose. You were able to literally purchase a home for 100% financing, meaning that you didn't have to put any money down. You also didn't have to prove anything as far as your income goes. You could be self-employed or you could be a W-2 wage earner, have a job, and either way, you wouldn't have to prove that you made the money that you said you made. Literally, the loan applications were a paper foundation for purchasing a home. A paper foundation is much less even than a sand foundation, quite frankly. It was so easy for this whole thing to come unraveled. What was happening was the financing was so loose, meaning that, again, anybody could purchase a home, 110 and 120% financing at the time. And it was called a ninja loan. It was a no income, no asset loan. So people were purchasing homes, no income, no asset, proving it all, and they were just writing on the loan application what it was that they made. And many times they would start at how much they needed to make and work their way back. That by itself was a big part of the problem. The other big part of the problem, and maybe you could argue the bigger part of the problem, is that Wall Street was actually making money on these loans as well. There is it's what was called A paper product, B paper product, all the way down to the 100% financing, which was really, in essence, at the end of the day, F paper product if you were to put it on a grading scale. What was happening was there would be different banks across the board. So Bank of America, a prestigious bank. There was also other banks, like there was World Savings, for example. They were really big on the loans that were negative amortized loans. So what would happen is you'd purchase a home and you would put down X amount, then the loan would be a negative amortization loan. That means that you'd only have to pay, I think, 1% interest only on the loan. So your monthly payments, a $700,000 home, let's say that it's $700 a month, basically on the loan. So $700 a month payment, but the negative amortizations on the back end of that. And so it's going against the equity of the home. A negative amortization loan, I can do a whole video on that by itself. But this, I'm going to focus on the different types of banks right now. So all these different banks, World Savings was one. They actually were pretty good, but then they started to slip. Chase and Bank of America, they were kind of on the top. Wells Fargo was also on the top. And those banks are still around. That's kind of a leading factor as well. Those banks are still around. So what happened was, as soon as all of this started to fall apart and Wall Street was making money on these, they were packaging these loans in the sense of they would have A paper and they would have A paper, and then in between they would have that D and F paper, right? And so they would take these files. Now we have servicing departments. The servicing department is the one where you pay your check to. All of these loans were sold to different banks and they were sold at different rates. So when you purchase a home and you have a 30-year note or a 5-year note or a 3-year note, and those notes are adjustable rate mortgage or a fixed rate, that's what a note is. When you have those notes would be sold to the next bank. Now they're sold to a servicing company, or a servicing company works for Bank of America or works for Wells Fargo. You send the check to the servicing company, and the servicing company then divides the money into the interest and to the principal. When they were selling these loans, they were packaging them together. Wells Fargo would sell it to B of A would sell it to Wells Fargo, but then they would also sell it to other countries. Now, one thing to know is that the files themselves did not actually have to go anywhere, because the files themselves would eventually get there, but what was happening was the note itself was being sold. So the note would have to go, but the note itself was being backed, and the reason that you have an A paper, B paper, on down to F paper is the amount of risk that might be tied to that note. If you have somebody who has not had a mortgage before and they've purchased a home at 120% financing, they don't have the built up ability to show, hey, I have paid my bills on time for the last 10 years, 5 years, 30 years. My financing is going to be sound because I know how to balance my checkbook. I know how to not spend more than I make. And so that's why those notes were less desirable. They would base this packaging to sell to the next bank. And this next bank would then take that packaging and say, okay, so we're going to service these loans across the board. Then what happens is that some of those loans don't perform. If a loan doesn't perform, that means that now the bank is going to go into the position of getting the property back, because the bank is not in a position of property. The bank is in the position of money. The bank does not care about how much a property is worth necessarily. They care about how much the note is worth. They care about how that note is going to perform. They care about getting their money back. So if your house depreciates all of a sudden, for example, in that scenario, the bank doesn't more or less care. Ultimately, in 2008, there were things that were done just because there was a big issue. 2008 was such an absolute nightmare. 2007, 2008 housing crisis was so horrific that the banks were closing. There was a point in time where, as a loan officer, I was getting a loan approved and getting docs to title. So a buyer is going to be purchasing, and one of the last steps now is that they're going to sign the documents. At the time, almost one of the first steps was people would sign the documents, and then we'd hope and pray that we'd actually be able to close and that bank would actually stay open. There were actually multiple times when I'd be working with different banks. I was a broker. I didn't work for one specific bank. And I would actually have to run a file with 3 to 4 different banks at a time, because it was very possible 3 of the 4 banks I was working with would actually close and not be able to fund the loan. That's how horrifying it was in 2007 and 2008. Not to mention that when in 2007, 2008, if somebody had a line of credit on their home and they hadn't used it, there is a callable note that is inside the paperwork for a line of credit. And that callable note says that if the bank sees fit, they can close that line of credit. So you have people who in a time of dire need have had a line of credit on their home and been responsible with it and not used it or have paid it down, all of a sudden be cut off from that line of credit, or worse, a letter in the mail, they get hate mail from the bank saying, we need our line of credit back. We need the money that you borrowed from us back. And so the biggest reason for that is that a second loan with a bank has no recourse. So that's the biggest reason for it. Remember, the bank wants their money back. That's why they're in the business, is to get their money back. You write a monthly payment to the bank. Ultimately, the bank's going to get paid back, and that's what the bank is looking for. So the second loan has no recourse, meaning that if the bank has to foreclose on the home, then the second note, $100,000, $150,000, whatever it might be, has no recourse, meaning that $150,000 to the bank is going to be dried up. And if the home itself is foreclosed or sold, then the first loan has recourse, meaning that the bank can come after the home to sell the home, and ultimately then go after the seller or the owner of the property if they choose. And the second loan has no recourse. Second, third, and actually there was actually second and third loans at the time, and sometimes even a fourth loan. People would get a fourth loan on the property, and so anything after that first loan had no recourse. So the banks were actually coming after the money at that point. That's 2008. That is the credit crisis. That is the time that the rug was ripped out from everybody who's in the financial sector in any way, shape, or form. And not even in the financial sector, but everybody. If it wasn't managed the way that it was managed, then we would have absolutely gone into the second Great Depression. Fortunately, we're calling 2007, 2008 crisis a Great Recession and not a Great Depression. Thank God. And that was different tools that Ben Bernanke actually came up with. He's the president, chairman of the Federal Reserve. Ben Bernanke, best Fed chair of all time. I would absolutely say that. Bottom line, I don't care who says what, Ben Bernanke is the man. He pulled us out of 2008. Nobody else did that. It was Ben Bernanke. Treasury Secretary, no, they didn't do it. It was Ben Bernanke. So when you look at what happened in 2008, it's pretty amazing to thank God we pulled out of it. So 2008, we were starting to get the interest rates back up. COVID came, interest rates had to go back down. So now interest rates are coming back up again because we're coming out of COVID. Interest rates coming back up is actually a good thing because inflation is heating up. When inflation heats up, it means that the economy is doing well. When you look at the economy is doing well, the Fed is going to start to raise the interest rates because that helps to cool the economy, so to speak. And so right now, historically, there's only been one time when interest rates go up and housing prices drop. And that was in 2007, 2008 because it was a financial crisis. And that was why. Right now what's happening is interest rates are going up to help to cool the economy. A little bit. Who knows how much. During the interest rates coming up, the housing prices are going to continue to go up historically. And then you look at the recession. So there's a possible recession coming. Again, the Great Recession was much different. The Great Recession, again, was caused by finance. The Great Recession was caused by the very means that ultimately was not performing. That was the issue. Right now, what we're looking at, a recession that's being caused because of the inflation. And when you're looking at the inflation, interest rates are going up to help to cool the economy. Ultimately, to me, I see things from a different perspective. When you're looking at the housing market, I'm specifically looking at Silicon Valley. The Silicon Valley is one in its own, and the Silicon Valley tends to be very resilient and completely different from any other housing market. There's no question about that. And there's other housing markets that are different than Silicon Valley in its own positive or negative way. But we are completely different. If you look historically, Silicon Valley has gone up and continues to go up. And whether it's a ridiculous up, it really doesn't have that tremendous down that you have seen in some markets. I'm going to end with this. There's 2 times that the housing market will actually crash. One is when credit is too loose. Right now, credit is not too loose. Bottom line, credit, if you look at this index, credit when it was at the top in 2008 was super loose. And now at the bottom, it's almost the opposite of what it was. And then the second one is going to be when the economy stinks. And the economy is actually very strong right now. The economy is doing fine right now. And that's why I'm saying I don't see the bubble bursting. I am absolutely here to help in any way possible, and I'm always happy to talk about this. I am passionate about it, but I don't take a hard line on it, and I'm happy to have a conversation about it. I'm not going to belittle thoughts or anybody who might be frightened about it. I'm always going to speak directly to the facts, really plead a case, sometimes playing devil's advocate. But this is what I see right now. I don't see housing taking a crash. I don't see that we have tremendous issues. I see that things are going to level off, and I see that things are going to work out for the best. Give me a call with any questions, 408-393-9294. Take care.